Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, September 1st, 2018. And today I wanted to talk about the oilfield services recovery, subscript, heads we win, tails we win more. So we've been talking about oil as being a market we want to be involved with. It's a market that was very decimated. Some people have described the oil field recession or slash depression that we had over the last few years as being the worst that they've ever seen in their entire career. However, that's now changing and oil prices are up, yet I think that quite a few people still do not understand that this is a broad-based recovery and that the oil price is poised to move significantly higher. So we've talked about this before, but here's another chart to reiterate what we've talked about, that we've had tremendous underinvestment in new oil supply, as you can see from this chart, which shows the global investment in upstream oil and gas, upstream meaning discovery and exploration and discovery. We saw a run rate of between $700 to almost $800 billion a year for the years 2012 through 14. Then we saw in 15 and 16 subsequent 25% decreases in capital investment. As you can see, 2017 showed a slight increase of 4%, and there's a projection that the overall increase this year will be 5%. But we're still bouncing around the bottom of slightly above 400 billion barrels or $400 billion per year, which, if you look back to the previous years, is almost 40 to 50% lower. So as we'll get into the further charts in the video, it simply is not enough investment being made in finding and bringing online new oil production. Because of demand growth and depletion, that is setting us up for a substantially higher oil price over the next few years, in my opinion. So here's a chart that we've shown before. It talks about conventional crude oil resources discovered per year. They've been in decline. The red line is the actual billions of barrels that have actually been discovered. They've been in decline since around 2010. Obviously, we cannot have a sustainable increase in demand and supply if we're only finding 5 billion barrels a year and we're using 30 billion barrels a year. So I like to show this because even when we were spending $800 billion a year, we're simply not finding the amount of oil that we need to replenish our stocks. We've basically been living off a lot of discoveries that happened 15, 20, 25 years ago. And at some point, this being an extractive industry, we have to find more oil. For those that seem to think that oil demand is going to shrink, it's going away very soon, if not this year, early next year, we should be cracking the 100 million barrel per day in demand level. That means 100 million barrels a day being used worldwide each and every day of the year. So as you can see, even going back when we had the decreases in oil investment, we were still increasing demand anywhere from 1% to 1.5% over the last 6 or 7 years. So adding 1 million barrels of demand every single year. And as I will show later on in the presentation, because of countries like China and India now entering what we call their S curves in energy demand, I don't see this slowing down. So very interesting chart here. This is basically showing the top 10 oil consumers in millions of barrels per day. Obviously, the United States is at the top. It has 325, 340 million people living in it, and we use 19 million barrels a day. We produce about almost 11 million barrels a day. That means we're importing 8 million barrels a day. I think it's kind of funny as a side note, all of this discussion about oil or energy independence. The United States is not and never will be oil, not oil, will not be, we'll have to import oil. Let's put it that way. It's not going to be oil independent. It's a ridiculous thing that the media puts out and rah-rahs from Washington, D.C. The bottom line is that for many years, we've used substandard, heavy, sour crudes from Venezuela, Mexico, and places like that. A lot of our refineries in the Gulf Coast are tuned up to refine that type of oil. Quite a bit of the oil growth that we have seen in the Permian Basin and places like that is a lighter crude. Our refineries simply can't process it, so we export that. It's giving the view, though, in the media and by certain politicians that that means that we're heading towards some kind of energy independence. We're not. So anyways, going down further, I think it's more important to look at is, as I just said, the United States has a population of approximately 330 million people, yet we're the largest oil consumer in the world. If you look at China, which has 1.2 billion people, their oil consumption is 9.4 million barrels a day, about half of our consumption, and they have 3 to 4 times the size of the population. I think you can see where I'm going with this. Look down at India, which has even maybe around the same population as China or slightly larger, and their oil consumption is 1/3 of China's. So as these countries continue to get wealthier, as these countries have middle classes that develop, as these countries, people move from the rural areas to the cities and become middle class and start traveling and start buying cars and consuming goods that contain plastic and oil products and oil derivatives, we will see their relentless climb in oil demand over the next 10, 20, 30 years. So let's just assume that, we don't even have to get to the size of the U.S., but I mean, can the world deliver another 10, 15, 20 million barrels of daily demand? I think it will be difficult. I think it will require a tremendous amount of investment. And I think probably what's really going to happen is that countries like the United States and some of the Western European countries or developed countries are going to have to see their oil demand shrink so that these developing countries' oil demand will increase. I just do not think, living on a ball that we're going to be able to deliver those amounts of oil. But I may be wrong. I said this 10 years ago when Matt Simmons was talking about peak oil, and I didn't think we could get to 100 million barrels a day. I did the calculations then on a spreadsheet, and I was like, no way. But we did go through an oil shock in that time frame between when that was a popular view. So I think that if demand gets high enough, what basically happens is the price rises sufficiently to choke off the demand, and price will ration. That represents an opportunity for us because as the price rises, tremendous amounts of capital will flow into the oil market and the oil services market, and that's what we're looking for. But I think this chart is very instructive. You could easily extrapolate the numbers and see China and India's demand increasing over the next couple decades. It would take, the current growth rates 20 to 30 years for them to get even close to the United States, but it will be a relentless increase. That coupled with the ongoing depletion that goes on every year in oil reserves and oil production is the opportunity. So here's some comments from some second quarter earnings reports from two of the larger oil service providers. I think the first one is from Schlumberger, which I think is one of the largest service providers in the world. They've got their fingers in just about every market around the world. So the same thing with the second comment, which is from National Oilfield Varco, another large company that supplies equipment all over the world. So these comments are interesting. First from Schlumberger, broad-based recovery in the international markets has now finally started, which led us to recover sequential revenue growth in almost all geo markets and nearly product lines in the second quarter. And then from National Oilfield Varco's report, on the whole, we continue our steady march out of the worst oilfield downturn of a generation. All three business segments performed well during the second quarter. In fact, all three posted double-digit revenue growth sequentially, with each segment benefiting from stronger second quarter demand in most major international markets. So what this is suggesting is that capital now is flowing into new oil discovery, new oil finding or exploration, and these are the two of the companies that would see that those initial dollars, because they're on the front line actually doing the drilling, doing the servicing, doing the various things that need to happen at an oil field, at an oil drilling site, whether it be land-based or offshore. I think it's interesting. The reason why I think oilfield services represent such an excellent opportunity is because it's kind of following the model of the what I like to refer to as the Levi Strauss business model, if you will. Levi Strauss, as we all know, the purveyor of the ubiquitous blue jeans that you see everyone wearing, you wear yourself, was a guy that went to the California gold rush and opened a general store. He didn't go and get rich by actually trying to mine gold, look for and dig gold out of the ground. He supplied the tools and the necessary dry goods that the miners needed, and that's how he made his fortune. So I think, yes, I do like certain oil companies, but I think the easier way to make money and the better way to make money for most people is to focus on the oil services. The interesting thing about the oil services businesses are that based on the depression that we had that has been described, as you see by the CEO of Varco, the worst in a generation, what it did was it decimated and caused quite a few companies to go out of business. So what I'm suggesting is that there are less competitors. The people that are left in the business, like National Oilfield and Schlumberger, have really pared down their operations to the bare bone. So as the money comes back, as we go from $450 billion a year in exploration back up to $800 or $900 billion over the next few years, this revenue is going to flow into less companies, and these companies are really, really lean now, and we should see tremendous increases in earnings and cash flow based as this larger amount of money flows through less companies with less facilities and less ability to supply the market. So I think that low prices cure low prices. This is a cyclical business. The cycle has turned. It's time to get positioned if you aren't. I haven't talked a lot about it. I've talked about Ensco's being one of my favorite companies. I will be featuring a oilfield services company in the September issue of the Actionable Intelligence Alert, a company that's down almost 99% from its all-time highs during the previous high in the oilfield cycle. It's down 99% now, and it has also turned around and is actually cash flow positive and has earnings. So that's the type of opportunities we're looking for. Catch the bottom, the cycle's turned, look for the survivors, get positioned, and ride the wave as the cycle comes back. Like I said, I can't put that out on the general YouTube channel, but it will be available to subscribers of the Actionable Intelligence Alert, the September issue. Talking about offshore, this is an interesting chart that I got from Rystad Energy off, I can't remember what website, but as you can see, the amount of sanctioned offshore oil projects is running ahead of last year and running substantially higher than the 2016 level. The projection is that by the end of the year, we should be up 50% in the amount of projects that are moving forward as opposed to last year, and almost up 150% or 200% from 2016 levels. So things have turned. We've seen that. A lot of the stocks really haven't moved yet. It represents a tremendous opportunity in my view. The only downside I really see, guys, is if we have a worldwide recession that pares back oil demand, but that just delays the inevitable for a couple years or a year to 18 months. The bottom line is, as I demonstrated earlier, that oil demand is relentless in its increasing every year. Depletion is present. It's an extractive industry. Tremendous amounts of capital are required to stay in place to meet that demand and to overcome that depletion. It hasn't happened. We're looking at higher prices. So in conclusion, oil demand continues to grow 1 to 1.5% per year. China and India are just now entering their oil demand S-curves and should see substantial growth in demand for oil over the next several decades. Oil supply has to overcome 5 to 6% depletion every year. So summing that up, demand growth plus depletion equals 5 to 7 million new barrels that have to be brought online every year to compensate for that depletion and growth. That's the equivalent to finding or bringing online a new Iraq every year. So that represents, like I said before, hundreds and hundreds of billions of dollars of investment, guys. If it doesn't happen, the oil price will go up. As the oil price goes up, that will incentivize oil companies to go out and national oil companies to invest. They're going to have to go to these service providers. There's less service providers, supply and demand all over again. That's good for us. As I've said over and over for the last year that I've been talking about this, oil is an extractive industry and requires tremendous investment every year. The low prices the last several years mean less investment in new reserves and production, which we've shown again here and reiterated in this video. And barring a worldwide economic recession, we are looking at higher oil prices. Oil field services give us the best upside to play this return of capital investment and increases in new drilling and new service work. As we said before, it's the Levi Strauss strategy. So we've talked about this before. I don't know if we've got new listeners, but this, I think, Oilfield services and the oil market represents a tremendous opportunity. I still think that there's still great value in a lot of the oilfield services stocks. In the free portfolio, of course, we have ENSCO. It's up since we recommended it, but it's, offshore oil has not really, the drilling stocks haven't really come back too hard yet. We expect that to happen next year and the following year, but we are seeing activity increasing in other sectors in the oilfield services sector. So I think that's the way to play it, guys. We're going to be adding a new pick, specifically, like I said earlier, in the new issue that comes out the first week of September. And I think that this is a tremendous opportunity that should not be ignored. So I appreciate everybody listening. Please take a look at our Patreon. I'll put a link in there. We already have some people supporting us here. We appreciate the support. If you get value out of this, throw us a couple bones. It helps out. Again, the newsletter continues to grow. We appreciate the new subscribers. And if you want to see what the new pick would be, we have a deal running right now that if you support the Patreon channel, we will send you the current month's pick. We won't give you access to the whole newsletter, obviously, but we will send you the current month's pick so you can get a flavor of what we're doing here at Actionable Intelligence. So that's the plug. I don't want to plug it too hard, guys, but take a look at this oil field services stuff. Tremendous opportunity. Thanks for the support, and we'll talk to you next week.